Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. I'm Justin. I'm here in studio with my sidekick and executive assistant by day, Jennifer Carter.
Good afternoon.
And you can call us live at 512-390-1370 or send us your questions and comments to ask@fortwm.com. We're going to be talking about charting, trending, what we might look at as far as stock movements in the future, bond movements in the future. Are there reliable ways to maybe predict where you might want to be allocating your money? You've probably heard of moving averages, standard deviations, fancy charting terms you may have heard, but do they really predict price movements? Or are they mathematical mumbo jumbo? You don't believe in it? Or do you? Well, we're going to be talking about how technicians have analyzed the price movement over time in the stock market. And, they believe that markets do repeat and have identifiable cycles and patterns that you can identify and learn from. And then once identified, you can react accordingly. There are many disciplines of this technical analysis, and Tim Wood is here today to talk about his cycle theory work. So we're going to be very excited to delve into that with Tim. But, I was thinking about a couple of things this week during our dinner seminar. I talked about an analogy that I really like in terms of with respect to financial planning and experts in the field and people that really put their life work into, maybe it's technical analysis, maybe it's being a financial planner like myself, or maybe it's being a doctor. Then there's so many specializations out there nowadays in different industries and for different services. I thought about my son who, he's been experiencing 7. He's been experiencing nosebleeds, and try telling a 7-year-old, don't pick your nose, don't scratch your nose, and they don't listen. And, it itches, right? And so he's kind of damaged the inside wall of his nose to the point where it's just gotten really thin. So we took him to the pediatrician. Pediatrician said, hey, look, I'm not quite sure exactly what needs to be done here, but I do know a great ear, nose, and throat doctor that you need to take him to. I did a little bit of research on my own. I Googled and looked up, nosebleeds, what do we do for kids? And I found cauterization. I found a variety of different homeopath type, solutions and, arguments here and there, what to do, what not to do. And I felt pretty comfortable with the science of cauterization. Well, my wife gave me a call after my son's visit to the ear, nose, and throat doctor. And she said that it took him about 30 seconds to look at my son after opening up his nostrils. And he said, we need to cauterize his nose. And it's not a painful procedure. They use silver nitrate. You got to keep him out of the water. You got to make sure that, it heals properly. It takes about 2 weeks. But, the poor little guy has been bleeding, almost once or twice every week. And it's just really kind of sad. And, it upsets him, and it's, scary for him.
Right.
But that led me to understand that, or at least draw a correlation or connection between what I do, my specialty as a retirement planner, what we do at Fort Wealth Management every week with our clients, and maybe other people that specialize in different things in the financial markets, whether it's mutual fund managers or charting technicians, or if it's bond traders or stock traders, or if you're thinking about working with someone to put together a retirement plan for you and they're not a specialist in retirement planning, it's almost tantamount to working with your general practitioner, your doctor, having your doctor try to perform a heart surgery when you have a need for stents in your heart, or you have a need for some kind of a bypass. Who would feel comfortable going to a cardiologist, getting a diagnosis, getting a recommendation for some kind of surgery, going back to their practitioner and hearing that, telling the practitioner what the diagnosis was and the recommendation, and then having the practitioner say, you know what, I know that cardiologist specializes in what he does or she does, but, I've been working with you for the last 20, 25 years. I would just give me a shot. Let me try the surgery.
No way.
No way. And you know what? As much as I'd love to find natural remedies for things, we just, heart disease is one of the biggest killers in this country, maybe even in the world. And we just haven't found a lot of ways around some of these stents and surgeries. And so we need cardiologists, we need heart surgeons, we need these people to specialize in what they do, and they do that day in and day out. And that's who we're going to go to, because this is serious stuff. And with respect to your retirement, your financial planning, how you position your portfolio, how you do this retirement thing and not run out of money and maximize your tax benefits and everything that you can, leave as much behind as you want or none, right? Whatever your wishes are, you need to work with a specialist. And I just wanted to throw that out there. So Jennifer, can you tell us a little bit about our guest today?
Yes, Tim is a CPA and the editor and publisher of Cycles News and Views. Tim used the methods learned to correctly identify the 2000 top in equities, as well as the magnitude of the decline that followed. Throughout 2005 and 2007, Tim used his statistical analysis to warn his subscribers that the 4-year cycle was extending, and these methods proved 100% correct and were realized in association with the worst financial crisis since the Great Depression. These same methods were used to call the housing top in 2005, the commodity top in 2008, as well as the 9-year cycle top in gold in 2011.
Hello, Tim. Welcome.
Justin, thanks for having me.
Well, impressive resume there that Jennifer just read through. Tim, you were also a CPA, and I suppose that you're not practicing as a CPA today.
No, I am not.
And you found your way into the technical world of stock market cycles and newsletter writing. And how did that come to be the case for you?
Well, actually, in a weird sort of way. I mean, as I was a senior in college, and I took some. I had an interest in the financial markets, and I took this class. It was called Fundamental Investments of Equities or something like that, and it was literally a fundamental class, deriving equations and all kinds of crazy stuff. And the only thing I remember from that class was we covered a chapter on technical analysis. And the essence of technical analysis is that everything is discounted into price. And even if you look at the writings from the old Dow theorist, back in the day, Charles H. Dow himself, I mean, everything known to man, everything that I think, you think, every participant of the market, that all of their thoughts and beliefs, be it positive or negative, is discounted into that price bar. And so why do we need to worry about deriving equations and speculating on what may be when we have a price bar? It's all in price. And so that said, I that kind of was the spark. And so, yes, I spent some time in public accounting and in telecommunications business for, a number of years. But this was always a passion, and I correctly identified using Dow theory and the methods I learned from a great trader. He was actually at one time president of the Cycles. I think it was called the Cycles. I can't even remember. It was some kind of Cycles Foundation in Chicago, based out of Chicago, and Walter Bressert. And I took a course from him. Took about a year to get through, a hands-on course, and it just opened my eyes. And I correctly identified the 2000 top and the magnitude, as she said, the magnitude of the decline, and it was published in Stocks Commodities Magazine. And everybody thought it was crazy, but it happened. And we got the decline. I said that it would undercut the 1998 4-year cycle low for some statistical reasons. And then the market rallied out of the 02 low, and it extended, and it extended, and it extended into what was at that time the most extended 4-year cycle in stock market history. But I knew, based on statistics and some other things, that it was a bear market rally. And I know that sounds crazy. I'll get into that and explain why.
And Tim, I want to really delve more deeply into your pretty amazing track record with the work that you do. When we get back from this break, that's Tim Wood, editor and publisher of Cycles, News, and Views. We're going to be talking more with Tim about how to apply cycle theory to the market, then identify the patterns and react accordingly, and what supports this, what doesn't support this. We'll be back from the break. I'm Justin, Retirement Journey Talk 1370. Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-390-1370 or send us your questions and comments to ask@fortwm.com. We're visiting with Tim Wood, editor and publisher of Cycles News and Views. We're talking about how to apply cycle theory to the market, then identify the patterns and react accordingly. Tim, you have an impressive resume with respect to calling some of these market movements, and you're mentioned by many of your peers as a purist, one who does their own work. Maybe you can elaborate a little bit more on that so our listeners understand what that means. And can you tell me how you actually study markets?
Well, as a purist, I do not read anyone else's material, and it's not because I am closed-minded or anything. I don't want my own thoughts poisoned. I mean, if you read something, I think it's in your head at that point, and it consciously or subconsciously it's there. And I try to just do my own thing. And stay pure and stick with the numbers. But, the cycles allow you to quantify movement, and the Dow theory allows you to put it kind of in context, if you will. It's like a multi-layered approach. But, in talking about if we could, I said that we've been I think where I was that I said that we've been in a bear market, or I said that it identified the 2000 top and said that we would go below the 1998 low. Well, I said that based on some quantifiable, I call them DNA markers, some things that, every top, first you have to quantify trend and identify the cycle. Well, then once the cycle is identified and you know what you're dealing with, then it's a matter of, it's kind of like the doctor reading the EKG. I mean, the little squiggly lines have meaning. And if you understand those meanings, and I'm sure there's some statistical stuff tied to EKGs. I mean, I don't know, but the point is that they have meaning. And once you understand those meanings, then it has predictability. And so anyway, I don't mean to talk about the past. I want to get to the future or where we're at now. But the point is that the meaning of that allowed me to identify the top in 2000 correctly and say that we were going to go below the 98 low, based on those DNA markers and the statistics. Well, since then, here's the important thing, is that in conjunction with the 2000 top, I feel like, based on a number of things, and some of this stuff's floated around on the internet for years now, such as the job participation rate and velocity of money and so on and so forth, and people talk about that. But bottom line, the economy peaked in 2000. That is evident when you look at the 2000 top in equities and the behavior of volume going into the 2000 top. As the market expanded 4-year cycles, each 4-year cycle moved up, volume expanded. When the market would roll over, volume would decline. Market would turn back up, volume would expand. And that is classic, right out of a basic technical analysis book. Volume and price, they move together, expand. That expansion, buyers are coming into the market. It's just common sense if you stop and think about it. Well, at the 2000 top, it's like you fold the image over. It's like a mirror image. It changed. If you look at the chart, I've covered this in some of my newsletters. If you look at the characteristics of the market, as in conjunction with the 2000 top and the decline into the 2002 low, volume started to expand on the decline. And then as the market rallied out of the 2002 4-year cycle low and extended, it declined. Volume declined. And so it's a mirror image. And we've seen this time with the rally out of the 2009 low, volume is it's nothing. And so this has been from that technical perspective, if you will, it's been a bear market. But then if you add to that, for example, looking at the labor force data, it also peaked back in the late 90s, 2000. I don't have that chart in front of me, but that's an underlying fundamental piece of the economy. If you had a thriving economy in a true secular bull market, then there would be jobs and an expansion there as well. And what we've seen is an outright collapse. When we saw the liquidity infusion, let me back up for a second and say this. I left a piece out. Here's the essence of technical analysis. True secular bull markets are not born out of Fed intervention in QE 1, 2, 3, 4, whatever they did. True secular bull markets are born out of a sound technical, fundamental, and economic foundation. And so now that being said, when you look at the volume, it's telling us there is no sound. The very essence of technical analysis is not there. The volume tells us it's a bear market.
Yeah, and Tim, you've been on record saying that really we have been experiencing since the 2000 market top. Really, it's been a bear market rally, and I want you to explain that in a minute. But just if you're just tuning in, that's Tim Wood, editor and publisher of Cycles News and Views. We're talking about market cycles, how you might be able to apply some theory to to what you're doing, and then identify some patterns potentially. And this is the Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way all the way. I'm Justin, and remember, you can call us live at 512-390-1370. You can also send us questions and comments to ask@fortwm.com. If you've got a question for Tim or myself, feel free to do that. We'll put you on the air. So, Tim, can you just explain to us what you meant by a bear market rally?
Well, bottom line, bear market rally, I mean that the secular trend, the market has actually, it's peaked. I mean, in the real world, it's peaked. It's kind of like, let's go back to your analogy with using the medical terms. It's dead. There's nothing there. It's flatlined, and okay, they've given it the morphine or whatever it is, and they've hit it with the paddles, and okay, now it's got a heartbeat again, but there's nothing there to work with. This patient is dead. There's no underlying technical, fundamental, or economic factors to really support it. And so what they have done.
What about Facebook?
Yeah, come on. But what I'm saying is that so volume tells us that that we've moved into a bear market. We have job participation rate tells us that. We have velocity of money tells us that. They both just collapsed. So what has happened is that even coming out of the 2002 low, and if I was in the Fed's shoes, I'd probably do the same thing. They've tried to resurrect the patient. They're hitting it with the paddles, the QE. Mm-hmm. They're trying to get it going. And I understand that, that it's admirable, and they've done a marvelous job at trying to get it going, but it has failed. And the reason it's failed in this sense. It's failed that it hasn't changed the volume characteristics. It hasn't changed the labor force rate. It hasn't changed the velocity of money. It's continued to collapse. It has fueled price to a new high. And so in that respect, yes, it's been successful. But there's more to a market than that. And like she said in the introduction, in the process of fueling and trying to rekindle this market coming out of the 2002 low, they created the housing bubble, the commodity bubble, and ultimately the worst financial crisis since the Great Depression. Well, what have they done coming out of the 2009 low? More of the same that created the worst financial crisis since the 2009 low, since the Great Depression, and they fixed nothing. In fact, they have now, if you look at the volume, it continues. It's worse than it was going into the 2000s.
Sounds like what you're saying is that we may end up with a Frankenstein.
Well, we do have a Frankenstein market, and what?
Yeah, and Tim, actually, I've got to run to a break. I apologize, but I want to keep you going. So when I get back, I want you to finish that thought. You're going to want to stay tuned to listen to Tim Wood, editor and publisher of Cycles News and Views. We're going to be talking about market trends and what you may want to know. And again, this is Justin, Retirement Journey Talk 1370.
Ooh, the wheel in the sky keeps on turning. I don't know where I'll be tomorrow. Wheel in the sky keeps on turning.
Talk 1370. You're listening to Retirement Journey with Justin Fort. You can call us live at 512-390-1370. We want your opinions. We want your questions. We want to know what do you think? Does market trending, moving averages, standard deviations, and all this chart work really help us predict price movements, or is this just a bunch of mathematical mumbo jumbo? So feel free to give us a call and tell us what you think, or ask us a question. We're visiting with Tim Wood, editor and publisher of Cycles News and Views. Tim has a pretty good track record as far as predicting a number of things like stock market top in 2000, housing top in 2005, oil top in 2008. So, it's very difficult to argue with performance, right, when things actually come true. Before the break, Tim, we were talking about what the government's doing. In a lot of ways, there's some artificiality to the stock market movements that we've seen, from quantitative easing, government spending, increasing debt, entitlement programs not being reined in, and really this old kick the can down the road, just vote for me and I want to be reelected type stuff that's been going on with the government, which I would imagine that you probably agree with. A lot of the clients that I visit with, they want to know really what to expect moving forward, and how can they protect the nest egg that they've got that now may be as big as it ever has been. And they're concerned about whether or not we're at another top. They're concerned about what inflation rates might look like. What's the normal return moving forward in stock markets? And what can we predict with relative probability, like in our favor, right? Such that we can take some kind of an income from that. Can we gift money? Or are we going to need that money? These questions are questions that, if you're listening right now, these are questions that are probably going through your mind, and you may need some help. These are the things that we deal with day in and day out at Fort Wealth Management. I'll tell you, I've got a crystal ball on my desk, and it really doesn't work. We really don't know the future, but we can look at the past, we can look at the trajectory of things, and we can get some feel for where things may be going. But we have to be careful to remember that even if we were pretty comfortable with our predictions, those things may not always come true for us. And so we have to be a little more conservative on estimates. We have to position things the right way, so that if we do have a crash sooner than later, or we do have a correction in the market 3 years from now or 5 years from now, you're not going to be put in a position where you have to reduce your standard of living. So again, I do this day in and day out as a financial planner there at Fort Wealth Management. I want you to give me a call if you'd like to schedule an appointment. The phone number is 512-433-6492. I'd love to visit with you and see where you are. And remember, this show, we're not giving you recommendations. We're not saying that, we know necessarily the future, but I've got someone like Tim here that's going to help us with understanding a little bit of the research that he's been doing, kind of give his opinions as to where things might. He's got a good track record in the past, but again, every plan is different, every position is different, and we don't want you to go try this at home. So definitely meet with a financial professional before you go and make investment decisions based on today's radio program. Tim, I just feel like sometimes I need to add a disclaimer to some of the things out there, because I know people, I don't want anyone to get injured with anything that we're saying. And not that I think we're saying anything that's really outlandish at this point. And we're not trying to scare people, but, a lot of individuals that come to our seminars or I've been meeting with over the last couple of months really are looking at the stock market. They're looking at kind of these trend lines, and they're saying, you know what? It's just making the hair stand up on the back of my neck. I don't trust the government with what it's doing, and I need to protect my family. What do we do about that?
I agree. And let me say that this stuff works. The cycles, the statistics, and so forth, you wouldn't have, or I wouldn't have the track record if it didn't work. And for someone to say it doesn't work, then, I don't mean to be offensive, but if someone says it doesn't work, then they don't understand it, because it absolutely does work. And that said,
and Tim, can I add to that, actually?
Sure.
It's a lot, just like the doctor analogy again. I'll tell you that the reality is, and this too, and part of the problem that people like you have, I think, in terms of being a technical analyst, is that there's so many people that have just kind of jump on that bandwagon of, maybe they want to scam people into buying their books or their programs, which really doesn't have, it's just back tested. It's not, maybe it's built based on hindsight, but really, or it's just nefarious, right? And these people get in the way, and they may use pseudoscience or a lot of lingo that trick people, and then they move their hard-earned money, their retirement money, into these types of investment schemes, if you will, and they get injured, and then it may really, and I believe it makes the technical analyst pool of people that are really trying to look at things the right way, and obviously are not trying to scam people, but just looking to try to get a better understanding of where we might be going, kind of a bad name.
Right, it can be discrediting. There's no question. But look, where are we going? Let me say this, and this whole secular bear market thing. Let me back up for a minute, and I'll get to the point. But I have to lay some groundwork. Talking about a secular bear market, and I know people are saying, "Well, how can you be at a new high with us being a secular bear market?" Like I said, the secular bull market is not born just from price. There are some underlying things. It's been fabricated. It's camouflage for the underlying economy. And as an example, looking at a price example, everybody knows about the bear market, the secular bear market from 1966 to 74. What most people don't know is that the market advanced out of a 4-year cycle low in 1970 to a new high in early 73 before it collapsed I think it was 45, nearly 50% into the bear market low. So yes, you absolutely can have a move like this within the context of a secular bear market. It's camouflage, people. It's camouflage, and it's been fueled and extended by the efforts by the Fed to get things going. But their efforts have failed in every respect except its levitated price. Okay, so where are we now? Here's a statistic, and this is a fact. My research goes back to the inception of the industrials in 1896. I have original writings by Charles H. Dow. My research is not just in the last 20 years or goes back to 2000 or so. I mean, I go back to the beginning of time, basically, with equities. And so in looking at that, what I discovered is that first of all, the trick is identifying the secular bear market periods. Well, Charles Dow did that for me during his time in his writings. And then the guys that followed him, Robert Ray, he identified secular bear market periods. They were the Dow theory founding fathers. So I used their work, their time frames then, and overlaid the cycles work. Well, what I found is that in every secular bear market, the 4-year cycle declines below the previous 4-year cycle low. That fits. In 98, we had a 4-year cycle low. We had the top in 2000, the bull market top in the secular bull market top in 2000. I said based on the setup and the DNA markers with that top that we would go below the 98 low. It did. Okay, check. That's evidence now, hard evidence based on data going back to 1896 that we also transitioned, I guess I should say, into a secular bear market period. Then we rally out of the 02 low, we go to a new high. What happens? Bam, down below the 02 low. Check again. It is consistent. That is a 100% rule going back to 1896. Every 4-year cycle decline in every secular bear market has declined below the previous 4-year cycle low. All right, look at the current situation. The 4-year cycle low was in 09. You say, well, my God, that's been more than 4 years ago. Yes, it has. They have extended it beyond belief. We're now in month, I think it's 77 or 78. And you say, well, how can that be a 4-year cycle low? Well, I have DNA markers, I call them, because cycles contract, they expand. Looking back to 1896, there's been 28, I think it was, 4-year cycles. Roughly half of them been a little less than 48 months, roughly half of them a little more than 48 months. But so they breathe. It's not like clockwork, and sometimes they may be 38 months, maybe it's 54 months or whatever. But there is a rhythm, a general rhythm. And so how do you know when you have the top or the bottom? Well, that's a good question. And so that's why I developed these markers, these very specific checklists. I go, okay, you got to have this and this and this and this has occurred at every top and every bottom. So then you apply that, and that's what I used in 2000 and in 2007. I said, this is an extended 4-year cycle top. People tried to say that the stock market had peaked in 2006 or that the 4-year cycle was in 2006. Then when we came out of that low, that we were in a fresh 4-year cycle and that we were good to go. And I said, no. This thing is extended, and why? Because we did not have the DNA markers.
So
Real simple.
Tim, do you believe that the our government, as well as maybe other governments around the world, like China. There's a lot of talk about China and their GDP, how it really probably wasn't something like they said it was. It's probably a lot lower than it has, than they said it was over the last few years. Do you believe that those cycles can be changed permanently based on new information, or in a new world where we've got such connectivity through the internet, trading programs and platforms and such?
I think that they can be. No. The short answer is no. But I think they can be affected. I think obviously they can be extended. But up until the 2009 low, and certainly the 2002 low, the 4-year cycle has been like clockwork. Like I said, they did not prevent the decline into the 2009 low. It came. They extended it and extended it. The DNA markers fell in place, bada bing, bada boom, and down it went, and the statistic was fulfilled to the T. And so I would think we would be hard-pressed to throw all of the history since 2009, from 2009 to 1896 out and say, well, we're in a new paradigm, it no longer works, especially when you're looking at the same underlying characteristics. I think we're dealing with an extended cycle. And I don't know. Maybe this time is different. Maybe this is the time. But is a person willing to bet on that? I mean, maybe this is the time that the statistic is not fulfilled.
I think it's a bad idea to not include all known evidence when making decisions. I totally agree with that. And I've got a lot of, I did a lot of research before our show, and I've obviously done a lot of studying in my work through the university programs and through just leisurely reading and trying to grapple with, trying to answer the questions that our clients have and position them the right way. I think that it's important to take in all these things into consideration, but of course, we always have to take things, at least in my sense, when we're talking about retirement planning, I'm not talking about people that have $50 million, $100 million where they can take risks in such a way. If we're not very confident or fully confident with exactly how things are going to play out over the next 5-10 years, we just maybe possibly need to err on the side of being a little more conservative. I need to go to break, Tim, so I apologize, but I definitely want you to finish your thought, and I want you to tell our listeners where you think we're headed over the next 5 or 10 years, and what we might expect after all of the things that have been coming this way to extend this longer cycle, as you put it. Again, this is Justin, Retirement Journey, Talk 1370. Talk 1370. You're listening to Retirement Journey with Justin Fort, where it's all about the health, wealth, and freedom you need to live life your way, all the way. I'm Justin, and you can call us live at 512-390-1370 or send us your questions and comments to ask@fortwm.com. We're visiting with Tim Wood, editor and publisher of Cycles, News, and Views. We're talking about how you might be able to apply cycle theory to the market, then identify patterns and react accordingly. And Tim, you were just about to, before I had to go to break, explain to us, or at least give us your insights as far as your expectations, and to maybe help our listeners out with what things they might be able to do, and some of your predictions, I suppose you might say.
Right. Well, because let me preface this by saying this is not gloom and doom. Information, it's like Gordon Gekko said. What was the quote? He said, what is the quote? He said something to the effect that, the most valued commodity is information, or something to that effect. And so this is having the knowledge that something bad may happen and being able to avoid it is a good thing. Being blindsided, that's the negative. So, it isn't gloom and doom here. It's just math. It's just statistics. It's just history. And knowing, having the evidence that we're in a secular bear market, and the evidence that I've been right so far, and knowing the statistics associated with this, what appears to be the extended 4-year cycle, most extended 4-year cycle ever, then I have to conclude that this is the most dangerous stock market environment ever. I mean, seriously, looking at this data and the environment that we're in, we've never seen anything like this. Of course, we've never had the intervention to get us here, so that kind of makes sense. And so I have to stick with these statistics. Like I said, I have DNA markers. They fell in place in 2007. And, we're trying to set up. Like I said, I'm not trying to avoid telling someone, but it's something that we're watching on an ongoing basis. And when we have our checklist, when it's all in place, then it's like the die is then cast. And I believe that once that happens, there's nothing the Fed can do. There's nothing it's done. And then I believe that the statistic is going to be fulfilled. I have to side with that statistic that we're going below. I know it sounds crazy, but the statistic says we're going below the 09 low. That's the risk, and that statistic has been 100%. And so I have to side with that statistic until it proves otherwise. And
Tim, if I could just add a couple of thoughts as far as how I work with individuals that use our services for financial planning. Really, in the retirement planning space, it's very important for us to really not peg too much on the expectations of the market, timing the market, right? I don't want to tell people that, it's as right as I may feel, and I'm not arguing with your right. research or anything. I'm actually arguing in the sense that if you can't take risk with your portfolio such that if we were to have a market correction within the next 3 or 5 years, you ought not to be positioned in that way with whatever money you don't want to be positioned towards those kinds of losses or corrections or something, right? There are other tools, other methods in the financial planning space that we use with our clients that we can use with you. We can avoid having laws. We can go to principal protected sources, whether it's through a bank, an entity that puts something in writing. If it's an insurance company, you make sure that they're strong and A-rated, and they have the claims paying ability to back those kinds of guarantees. You don't have to be timing the market to try to survive in retirement. And I would argue that, and you might agree with me, Tim, that most people are not going to be savvy enough to know. And maybe now after this show, they'll know to maybe follow some of your stuff. But the reality is they may be lost when it comes to who they should use when it comes to predictions. And often I find people are doing it based on gut feelings. They're doing it based on a magazine they read two weeks ago or something. Right. And they're often getting this wrong. We just know statistically the average American underperforms the market so terribly by moving between funds, and they're just, and I really believe that a lot of hedge funds, investment banks are just making a killing by trading against, and I know there's evidence of this, trading against the average investor and basically stealing their bacon because they're watching the average investor who doesn't have the kind of expertise or the time to put into looking at charts and trying to make their predictions. Often we find that there's I find that there's a self-fulfilling need, I guess, to look at past performance of an individual. I had a gentleman that came in a couple months ago. He said, I'm so great at timing this. I got out before 2008. I got back in here. And I said, well, great. How'd you do that? He said, well, it just happened. Like, you just felt it. You see what I mean? And right. That's dangerous if we get this kind of self-confidence and we're not backing it up with data. And what you're saying is that you're using data, and you're not looking into a crystal ball. You're not trying to write books that people could buy, just doom and gloom, fear and scare type stuff. You're right. Just trying to look at how things are going, how they've been in the past, and to try to get some insight as to where we may be headed. And I just personally, from everything I know through all the training I've had education wise in my research, and I've done a lot of research on this idea because it's very important to my clients. I found that we just can't exclude anything. We really need to be open to look at everything, but we have to err on the side of we may be wrong. And so if right. we may be wrong, what might we do to just protect ourselves a little bit more? Can we put the proverbial net under the trapeze? So if we miss that trapeze swing, we don't hit the floor. We've got a net there. Is there something that we can do? And I'll tell you that there are things that can be done, but it is important to look at the trajectory of this country. It's important because we need our politicians to step up to the plate and quit kicking the can down the road and quit extending these, cycles like you're saying, right? And making our economy and our maybe our stock market look like what you were saying, and the proverbial Frankenstein.
Right. It only makes matters worse in the end, or at least that's what the statistics have proven. Let me say one more thing, though. In 2000, here's the one thing that bothers me at present. In 2000, I was basically alone in that call. I mean, I was laughed at literally. In 2007, as I recall, I was basically alone. I don't remember anyone publicly making that call. And I darn sure don't remember anybody saying that we would go below the 02 low. And so, that was good. I like being alone. The thing that bothers me now, these statistics are what they are, and it tells me what it tells me. But the thing that bothers me now about the general environment is that I'm not alone. There are people coming out of the woodworks. I had a guy send me an email. He said he did a radio interview and told him that 2 weeks, the market's going to crash in 2 weeks. It's like it's like the end thing. Everybody, I think maybe what it is that people know things aren't right. They can sense things aren't right, and maybe that's where it's coming from. But it does make me a little nervous that there's so many people talking about the gloom and doom in the economy.
Hence a self-fulfilling prophecy.
Right.
In a sense, right? I mean, and we know this is true. We do know, and this is academic, we do know that, in a perfect world, when we've got the efficient market hypothesis, which states that basically if we know everything and all the actors know everything that trade on a liquid position, the stocks ought to be appropriately priced based on all expectations and past knowledge and everything, right? However, there's this factor called the factor of the uninformed investor. They actually, in universities, they give it it's an F symbol they use in formula to show that really, even though the results we've got without the F factor involved could be fairly accurate, when you add the F factor, the uninformed investor or other market participants or hype or all these other things that go on, that's what makes it so difficult to really accurately time markets. And that's why, really I don't do that with my clients, but I think you're taking it more from a macro level, and you're kind of looking at, we're not trying to call a date here so much like a month or a day, but rather just what are we expecting now more likely to happen? What's the higher probability?
Well, it is from a macro level, but it's also from a micro level, and I guess the micro level comes in when you see the DNA markers. It's like I know the environment we're operating in, and I've known the environment that we're operating in. Now I need to see the evidence that this thing is over. And what I have said ever since the 09 bottom is I said, hey, this is a 4-year cycle low, and it's a rally within a secular bear market. But you know what? It's going to go up until we get our markers. And the thing is, we haven't seen them all yet. I mean, it has tried to set up, and then it would get blown out, and it would try, and it has not materialized. We're seeing it try to set up now. Does it materialize? I don't know. That's the crystal ball thing. I'll know it when it happens. And when it happens, like I said, I think the die's cast, end of story,
yep.
and then it's done.
Well, Tim, I agree with you, and I feel like we definitely have a very tough time ahead. The actions of the government, a lot of these market makers, there's a lot of complacency with people that feel like they're still going to get their 10 or 15% return that they've seen over the last 6-7 years, and that may just probably won't be the case. And if that continues to happen, I just don't want to see people lose their hard-earned money. I know you don't, and that's really why we're talking about this on the radio, so people can listen to us, right? Right. And maybe seek some help, get some guidance, try not to follow, maybe some of these wrong paths, or just don't injure yourself, right? Be a little more careful. Well, I've got to run to a break, but when we get back, I want you to help us, our listeners, understand how they can maybe get a hold of your Cycles of News, some of your newsletters and things like that, Tim. So we'll be back here in just a minute. This is Justin, Retirement Journey Talk 1370. Talk 1370. You're listening to Retirement Journey with Justin Fort. We're visiting with Tim Wood, editor and publisher of Cycles News and Views. Tim has a website, cyclesman.net. And Tim, before we went to the break, we were talking about how to apply market cycle theory, the patterns that you're seeing, the Frankenstein that may be, the stock market that we see today that's been propped up by a variety of things the government's been doing. And the world looks like, from a lot of people's view, that we may be entering a world recession. And I hear that on the radio, but yet I still see all this positive talk on CNBC. Of course, there's probably some bias there. But, Tim, if you could tell our listeners real quick, and this was an hour-long show that flew by. I really wish we almost need like 3 hours here with this kind of stuff. So I'd love you to come back. But before we tell our listeners how they can get a hold of your newsletter and visit your website, can you tell us what in your opinion, or your best guess might be, a correction might look like since we've had an extension of this cycle that at some point needs to end?
I have to, again, when we see the markers, the DNA markers confirmed, then I have to stick with the statistic, and the statistic tells me we go below the 09 low. I think that is the risk, and my stance is that that's my number one expectation until I see evidence that statistical expectation is not going to be met. And the reason I have to stick with that statistical expectation is that it has been fulfilled 100% of the time since 1896 in this sort of a setup.
And when, in your opinion, Tim, when might we? Do you have an idea?
I did not. I'm not trying to avoid the answer.
I'm putting you on the spot. I know. I apologize.
I don't know. No, I would love to give you the answer. I don't know the answer, but let me answer it this way. First of all, I did not think that this 4-year cycle would extend as long as it has. So, that said, could it extend further? Sure, it could. But I think we're on the brink of something. But I have to see the DNA markers. If we see those markers fall in place next week, next month, or if it's 6 months from now, then that's the answer, and that's what I'm monitoring. And so I can't give you a hard answer, but the answer is when we see the markers, the risk is tremendous because of that statistic.
Fair enough, Tim. I really appreciate your honest insight and your spending time here with us on the Retirement Journey Show. We'd love to have you come back in the future if you're willing.
Of course.
And we can definitely spend a whole nother show or two on this topic. So thank you so much. And can you tell our listeners how they can get a hold of your newsletter?
Cyclesman.com. It actually changed. It's .com.
Okay.
Cyclesman.com. All the contact information is there.
Cyclesman.com. Thank you so much, Tim Wood, editor and publisher of Cycles News and Views. So, we talked a lot about market cycles. Just remember that at Fort Wealth Management, we don't want to have to time the market to have you realize the retirement of your dreams. We want the probabilities to be in your favor, like you are the casino, not the gambler. We want our clients to have things in their favor and taking a conservative approach. But you know what? It's hard to argue with a lot of the things that Tim said today. And I know there's a lot of sentiment about what might be looming. And you've got to just make sure that you're proactive with making prudent decisions for you and your family. And we'd love to help you there. Again, at Fort Wealth Management, 512-433-6492 is our phone number. Schedule a consultation with me. I'd love to visit with you next week. A story that few are really following could have far-reaching consequences for America, and especially the 2016 elections, and not in a good way for conservatives. Puerto Rico is about to default for the first time in their history because they are so in debt. This is America's Greece. They're currently $72 billion in default on their public debt and are seeking U.S. bankruptcy protection. However, because Puerto Rico is not a state and are rather just a commonwealth, they are not protected under our bankruptcy laws. Josh Bernstein, spokesman for the AMAC, will be here next week, and he maintains Puerto Rico is another big run economy. Listen to his predictions on the matter and how it may impact you. We'll be back next Saturday, same time, same channel, 12:30 to 1:30. Want to thank again Tim Wood for being on our program today. Thank you all for listening and sharing this show with your friends and family and liking this on Facebook. We're having amazing results and a great following. And we'll see you next week. This is Justin Fort, Retirement Journey Talk 1370.